Okay, let's start because we have a lot of ground to cover. Thank you very much for joining another Into the Block webinar in which we try to cover some of the most exciting topics in crypto. It's been a little few weeks since I've been able to do one of these, since our research team sort of has monopolized the agenda for the last few weeks, but I managed for them to give me an opening. So today we're gonna be talking about a topic that is very close to the work we have been doing on the quant side, that is related to risk, the foundation of risk in decentralized finance. Specifically, we're gonna present a sort of a taxonomy to think about risk in DeFi. I want to show you a very recent case study that we were involved with in some of our trades. That is, whatever you're going to do not leave this presentation until that part because it's quite cool. And then at the very end, I want to show you some let's say, more futuristic ideas about risk management and DeFi, something that is not far-fetched from where we're at today, and that is possible to achieve, and that it will give you some ideas about what's possible. As always, throughout the presentation, feel free to use the Q&A panel for questions. We're monitoring it, so I'll stop multiple times during the presentation to take questions. So before we dive in, I just want to give you a quick update about Into the Block, what has happened since our last webinar 3 weeks ago. To begin with, we have a new release that is super exciting. We released a very large collection of what we call ownership indicators, that are analytics that give you perspective, give insights about the ownership of a specific assets, from the size, like large holder wells and things like that, to the activity, like addresses that are more active than other, that things like what you can see here, like a breakdown of ownership by different balances. And the most exciting part is that we were able to do this across many assets, not only Bitcoin and Ethereum. So you can see a lot of the composition analysis for all sorts of tokens, which is actually something very unique in the industry. In addition to that, we have done quite a few customer integrations, such as 3 Commas that we announced today at CoinCoCap. And there are a few others that we're gonna be releasing in the next few weeks. And then very soon, we're gonna announce that release about NFT analytics that we have been working on that for quite some time. It's fairly challenging, but I think we're getting close. So probably in the next webinar, we're gonna give you the same update. And then for the first time, we're gonna release a different website that talks about some of the work that we're doing on the quant side on DeFi. That is the biggest growth engine of Into the Block, but it's something that we don't talk about it too much publicly because our clients are very conservative and very discreet. About this today, you're gonna see some of the traits and things that we're gonna use as part of some of the examples that we're gonna use. But on this website, we're gonna provide more detail in terms of the capabilities of the ITV Quant platform. So let's dive in. As I said, the topic of today is risk management on DeFi, that because we do a lot of quantitative trading in DeFi, is an area that we spend a lot of time thinking about it. Now, when we think about risk in any financial market, we tend to go to traditional portfolio theory. So there is this phrase from the very famous economist Paul Samuelson, who said that Wall Street rests on the shoulders of Harry Markowitz. And he's referring to the fact that most portfolio management theory today is based on the theory of risk that was initially incubated by Harry Markowitz at the University of Chicago. And then it was sort of extended by one of his students. At least Markowitz was a PhD advisor to William Sharpe's thesis, in which he sort of expanded sort of Markowitz ideas using volatility for risk adjusted returns. And then Another famous economist, Merton Miller, did a lot of work on trying to provide sort of quantitative models that are for companies in a way that they're independent of the capital structure of the company itself. So together, the ideas of Markowitz, Miller, and Sharp are sort of the foundation of modern portfolio theory, and essentially all boils down to calculating risk based on parameters such as volatility and things like that. And that has been the case since the 70s. These three gentlemen shared the Nobel Prize in economics in 1991. And that they're still contributing to a lot of portfolio theory ideas. But in general, because a lot of the theory in traditional market it makes the assumption, rightfully so, that they're trusted intermediaries de-risking a lot of the aspects of a transaction. So if you're dealing with a market maker, then you know what the company is, and there is a counterparty risk that you can account for. But then when you go into DeFi and those intermediaries don't exist anymore, and you're dealing with smart contracts, essentially from a risk perspective, we're shifting that risk from a trust factor in intermediaries to the infrastructure layer of a smart contracts. And that's fundamentally the way you should think about risk in DeFi. In traditional markets, a lot of that risk is absorbed by intermediaries, by market makers, by lenders, by other entities. When that doesn't exist anymore, it's all transparent, which is great, but that means that risk is moving somewhere else, and it's really moving to the infrastructure layer with a smart contracts. Now, when you think about risk in DeFi, most people think about something called a smart contract risk. Recently, I published this article in Coindesk as recent as last week called the 5 risk vectors of DeFi. And the fundamental thesis is that there is not a single risk form in DeFi. It's not a smart contract risk. There are many forms of a smart contract risk, and there are many forms of risk in DeFi in general. So you shouldn't think about it like a single construct, but rather like a number of dimensions that you need to manage in order to create a risk profile for any form of investment that you're doing in DeFi. Fundamentally, we believe that most of the risk factors in DeFi could be analyzed following one of these 5 key categories. So probably the most important risk is what we call intrinsic protocol risk. And intrinsic protocol risk is a form of a smart contract risk, but it's a form of a smart contract risk that is not related to a hack, is not related to a failure in the smart contracts. It's related to the normal behavior of the risk behaviors that could emerge from the normal behavior of a DeFi protocol. There was a lot of behaviors in that sentence. So a clear example is liquidations in lending markets. So if you're borrowing and lending in a protocol like Compound, Aave, Benki, or so on and so forth, you can get liquidated because the market becomes under collateralized for several reasons. And this is an intrinsic risk of the protocol. It's by design, and you don't need to be doing necessarily anything wrong to be liquidated. But this is a risk, like as an investor, you should be aware of it. Another one is slippage. This is an example, a very famous example in Curve, in which the famous STETH pool in Curve that has multiple billions in it, one day, Justin Sun decided to remove 90,000 ETH in a single transaction in that pool, and that caused a lot of slippage. Thankfully, it reverted back. But conditions like this happen all the time, and traders get stuck in those positions for months without being able to get out, without having to pay very, very high fees. So the slippage is not a bug, it's not a mistake, it's a feature by design, but it's definitely a risk parameter that should be evaluated in any investment strategy. Then there is another form of risk that is what we call exogenous protocol risk. This is the one that the press likes to talk about the most, that is referring to hacks and failures and things like that. We call exogenous because are things that you cannot plan for as part of a specific trading strategy, or things that sort of come out of the blue. And the classic example of this are bugs in smart contracts that can lead to exploit in DeFi protocols. Obviously, we're just coming out of the wormhole bridge attack last week, so this is very present, and protocols like Cream has been exploited multiple times and things like that. And we see this all the time in different DeFi protocols. Now, hacks are the most famous, notorious, let's say, example of exogenous protocol risk, but it's not the only one. Oracle manipulations is also a very common one. Very famously, December, I think 2020, there was a very famous manipulation on CoinDesk for the price of DAI that allowed the Chainlink Oracle to reflect an inaccurate price, and a lot of liquidations happen in Compound based on that. So this type of Oracle manipulation attacks happen all the time. The same with flash loan attacks and things like that are forms of exogenous protocol risk. Then another dimension that you should be aware of it when thinking about DeFi risk is what we call governance risk. So DeFi protocols are, for the most part, their behavior is regulated in some form by the DAO's governance mechanics, and a lot of those governance votes could be subject to manipulation, and proposals could benefit some actors more than other, and this is a risk that you should be aware of it. Like very notoriously, just yesterday, I believe, some news came out that Justin Sun, again, was trying to influence a governance proposal in Compound that was going to benefit him. But you also see this with you see this in Curve very regularly with a lot of large CRB holders that are pushing proposals that are clearly to their benefit. So if you're an investor in these protocols and there are governance proposals that happen all the time, some of those governance proposals can have a clear impact in your position. So this is something that is unheard of in traditional capital markets. There is not an equivalent to that, because the governance rules for all equities or commodities and all that are well established and are the same for everyone. So you don't get that type of exposure to governance risk. A fourth dimension of risk in DeFi protocols is the underlying blockchain risks, right? So all these protocols run on layer 1 or layer 2 blockchain runtimes, and those blockchain runtimes suffer failures or changes or things like that. A very common one is consensus performance degradation. This has happened in several blockchains, very notoriously Solana. Recently, about 2 or 3 incidents in which the network gets congested, the consensus are not the consensus voting are not happening very fast, and then that gives attackers the opportunity to manipulate certain things in DeFi protocols. To give you an example, if the Solana network becomes congested, this is a real example that happened with the Solemn protocol. People were trying to repay their loans, but the transactions were not being processed, and a lot of those positions got liquidated. So this is a very common risk. Speed is one of the best mitigations against DeFi risk. So blockchains that are very fast, they're more secure by definition. So in DeFi in particular, speed mitigates a lot of the potential attacks. So when you have congestions at the layer 1 or layer 2 underlying blockchain runtime for a DeFi protocol, that's another vector that you need to factor in when analyzing risk. And then finally is what we call market risk. If you're an investor in one of these protocols, there are market factors that can affect the behavior of the performance of your position. So this could be from directional exposures to given assets to all sorts of complex combinations of factors. Probably the most notorious example of this is impermanent loss or divergent loss, it's called today, in which you enter a liquidity pool in an AMM protocol and the assets have high volatility and move one way or the other, and then you're incurring a loss by supplying liquidity to a protocol instead of holding the assets. But then you have things like liquidity outflows. That is also a market risk. So suppose that there is a negative news about a specific protocol and a lot of liquidity because about the in liquidity pools that are using the assets of that protocol, a lot of liquidity is removed, and the investors on that pool now they're exposed to massive slippage. So those are sort of the risk vectors that we see in DeFi, and they're all related. So these are not in isolation. It's hard to sort of have an impact on one and not the other. So this is a very basic diagram of how they're related. Almost everything has a direct relationship to intrinsic protocol risk. So if there is a hack in a protocol, most likely that's going to exploit a behavior of that protocol, which is an intrinsic protocol risk. The same with a vulnerability in the underlying blockchain. The same with macro conditions in the market, and obviously governance proposals, but also exogenous protocol risk. Like a hack could deviate into a specific market conditions, right? That causes outflows in a specific protocol. So these 5 categories are very intertwined, and they're very complex combinations to formulate a risk profile for these things. Ryan Henley is saying that maybe we should dedicate a section of the presentation to Justin Sun. Yeah, that's cool. Hopefully that he's not a pseudonymous for Justin Sun. And then Ting Fan is asking if they can get if there will be a copy of the deck. Yeah, we'll post a presentation online. So what I wanna do next is to show you some ideas about how to mitigate risk in DeFi protocols today. These are things that could be done. These are things that we are doing at Into the Block. And so no futuristic ideas or anything like that. This is, if you're invested in DeFi with certain level of automation, these are things that you should be looking at. The formula is very simple. There are 2 key factors that help to mitigate risk in DeFi. I think that this is a very nascent infrastructure. One is monitoring all sorts of factors, and the other one is automation. That's a very simple formula that we apply. So when you think about monitoring what? And there are many things in DeFi protocols, because everything is visible, that could be interpreted as risk conditions for a specific position. So for instance, liquidity flows. Is liquidity flowing in or out of protocols? That could deviate into a specific risk conditions. Liquidations in lending protocols. The slippage, which is a consequence of liquidity inflows or outflows. Volatility in strategies that have exposure to directional assets, like Uniswap B3 and things like that. Volatility is important. How about wallet composition? Who is in this component of a protocol that I'm using? What happens if a whale exits that protocol? Then governance proposals. What are the proposals that are being evaluated right now that could affect my position? So having solid monitoring over these factors is a good risk management strategy. And then automation is everything in DeFi happens very fast. Within a few blocks, a composition of a DeFi protocol could change. So being able to do a lot of these things automatically, like adjusting positions based on risk conditions, disassembling position if there is a risk condition, is super important. Those 2, automation and monitoring, to me are more important than anything related to any quantitative score or methodology to measure risk. So what I want to do now is, in a few minutes, show you something that happened to us that we were involved with, a trade that we were involved with a few weeks ago, and how a lot of these factors came together. Obviously, I'm not going to mention customer names or anything like that. But so the trade is very simple. So a few months ago, we assembled a strategy that supply liquidity to different pools in the Convex protocol in the Ethereum mainnet. And one of those pools was a famous meme pool from the Magic Internet Money from the Abracadabra protocol. The strategy has different components and was monitoring different risk parameters, such as liquidity in the pools and compositions of the pools. So we had several positions assembled, about 50 million total. One of those positions was very large, like 40 million. So the strategy was configured to exit based on a specific slippage parameters based on the composition of the pool. It was 100% automated. And it was super stable, high performance for a few months until a couple of weeks ago, this happened. So the news came out that the ex-Quadriga CFO was associated with the lead developer of a protocol called Wonderland that also happens to be a founder of Abracadabra. So look at the levels of indirection. So the ex-Quadriga CFO has a connection, is working on a project in Avalanche that has nothing to do with Ethereum blockchain, with the founder of the Abracadabra protocol that has a meme token that we were using in Convex. So there are like 4 levels of indirection there. So when that happened, there was a direct impact on the meme token, and liquidity start flowing out of the pool. So our systems start detecting liquidity outflows from those pools very, very early in the morning, even before the news came out. We saw liquidity. Yeah, there were some tweets and this started happening, but the press hadn't really picked it up. So we didn't know what was happening. We knew that liquidity was flowing, but the pool had about 2.4 million and we only have 50 million. So we were super, I mean, it was super easy for us to exit, but the liquidity outflows were massive. So look at this chart. So liquidity started declining. I got to levels that were very, very low. Particularly for you can see that 3 CRB, so the stable coins position were exiting the pool, and the pool was completely unbalanced, so there was a lot of meme in the pool. However, our strategy was just fine. Like we were monitoring the compositions of the pool, and our exit fee, the exit fees of our customers, it was only 0.05% slippage, so we could exit at any given point. So we decided to stay for a while and just follow the algorithm and disassemble if we hit a condition until a wallet analysis revealed. So another thing that we were monitoring, that is the composition of the pools, another risk parameter, that an address that we identify like Alameda had 530 million on that pool. And the pool at the time had come all the way down to 800 million. So we decided to exit the position ahead of time, because if Alameda will have to exit that pool, remove 500 million from the 800, it would have been difficult for us to exit without incurring a massive slippage. We exit, our customers realized a profit. One was flat because I just entered, one made 1 million, one made 55,000. And then we waited and figured out what was happening. And then hours went by, like 4 or 5 hours. And then finally, people started tweeting that Alameda was on that pool, and there are some funny tweets that were saying, look, these guys are asleep, like nothing is happening. And eventually, when they realized this happened, they exited and took a 90 million loss on that 530 million position, because they exited and converted back to stablecoin. So it happens to anyone. So this is not a criticism of anybody. But this is an example of how having that level of automation, monitoring, it gives you an edge on this type of infrastructure that is very nascent and inefficient. So this just happened less than 2 weeks ago. So it's a very nascent, recent case studies. So to finalize this, I want to leave you with 3 simple ideas. So we spoke about things that you can do today. That is a lot of monitoring and automation. We spoke about how you should think about risk in DeFi with exogenous intrinsic protocol risk, governance risk, market risk, and underlying blockchain risk. How about the future, right? Like what are things that you should expect to see in the near future, like in a year and a half time frame, like not super ambitious, that could probably provide better risk models for DeFi. So here are 3 ideas that we like a lot: quantitative models for risk, insurance, and this thing that we call protocol first risk management. Again, this is more to think about the space in a little bit different way. So a DeFi score, risk score, is a very simple concept. If we're monitoring all these things, if we're monitoring compositions of the pool, liquidity outflow, parameters, wallet exposure, previous hacks, all sorts of things, couldn't we compile this in a series of scores, like similar to the Sharpe ratio, right? That give us a more quantitative model to sort of analyze any market in a DeFi protocol, whether how risk exposed it is. Obviously, there are things like exogenous risk, like hacks and all that you cannot account for. But it should give you, there should be a more quantitative way to evaluate this than what we're doing now. Another idea that we like a lot is the evolution of insurance. So today in DeFi, insurance is very limited. You have protocols like Nexus Mutual that are doing a phenomenal job, but no financial market survive with a single insurance provider. So more better insurance models that factor in holistically different risk parameters, not only based on a smart contract risk, but how about market risk, governance risk, and things like that. We think that's super important and certainly achievable, and certainly there is a huge market for it. And then another thing that I believe we're already seeing the first iterations of this is this idea that we call protocol first risk management, that is essentially building risk conditions on the protocol themselves to be able to recover from things like that, from risky behavior. So today, DeFi protocols are phenomenally automated and very dumb, right? Like the behavior of most DeFi protocols by market standards is very basic. So as the space evolves, it's not crazy to see that a lot of the risk management behavior could be embedded in the protocol itself. So think about liquidity pools that would restrict the levels of capital that you can inject on the pool based on the slippage and things like that. Think about protocols that would insure automatically against impermanent loss. We're already seeing some ideas about this. So a quick summary of what we discussed so far, and I'll go to Q&A. So traditional risk management theory just doesn't apply in DeFi. You need to forget about volatility and Sharpe ratios and all that, and think about this from reimagined risk management from the ground up. There are different ways to think about this. A taxonomy that works for us, that we think is compelling, is dividing the smart contract protocol risk in between intrinsic by design and exogenous hacks or external factors, governance risk, exposure to blockchain risk, and macro market risk. Programmability. So monitoring and automation are the two keys, the two top things that you can do today to mitigate risk. And then there is going to be a ton of work done in risk management for DeFi in the near future. So that's all I have. Somehow I was able to cover all this in 29 minutes. So I'll go to questions, but before that, I want to point you to our next webinar that is going to be diving into crypto evolving dynamics. It's going to give you, we're going to present sort of the new behaviors and patterns that we're seeing in the new climate of crypto, if we can call it like that. Our head of research, Lucas Otomoro, is going to be leading that webinar, and the link is in the chat. I would like to thank you very much. This is my contact info in case you want to contact me directly. And then I'm going to go to questions right away. So there are a few people asking for the presentation. We're going to post it online. So Karan Rajpal is asking, what other layer ones are on your radar where DeFi quant strategies can be deployed? Almost everything that has DeFi protocols with liquidity. So today we have, without getting detailed, we have over 50 strategies in production covering 6 blockchains and a ton of protocols, but there is a lot happening everywhere. These days, there is a lot happening in Phantom, Avalanche, Solana, Terra. So there, as everywhere that there are DeFi protocols with liquidity, there is a potential for strategies. Then Karan also asked, can you go deeper on the impermanent loss and how it can be managed? So different ways. So there is we have done a lot of work on this, mostly unsuccessfully. The traditional mechanism of hedging, right? There is a lot of articles and things talking about hedging impermanent loss. We haven't found any mechanics that work generically for every pool. So we think that hedging with options works in some scenarios, and in others it just doesn't, because just the composition of the contracts. So we try a number of things, and essentially the hedging part was eating like 90% of the profit. Then there are mechanisms like insurance, right? Bancor is doing some of that. We think that's super interesting. So insuring against impermanent loss, protocols that absorb the risk, we think is a very interesting idea. And then what we typically recommend is go on pools with assets that are highly correlated, Bitcoin and Ethereum and Avalanche, things like that, that they move in tandem, and you're able, because essentially you're going long volatility. In those cases, you're able to if they move together, you're able to mitigate into the impermanent loss much better than if you're doing something like a stable coin, an ETH or Bitcoin. Enrique Palacios is asking, I didn't find a recorded session about derivative. Our head of marketing will be in touch with that. How did the Wonderland case affect Luna? Not directly, but there was a lot of uncertainty at the time. So there was a lot of movement on Luna pools when that was happening, but there was not a direct impact. I think it settled very well after. I mean, it calmed down very rapidly after the fact. From what I remember, I don't know if anything else happened. I'm probably not aware of it. There is a bunch of thank you notes there. Andrew is asking, can your ITV analytics simulate transactions until in an LP? Not the analytics that we have on the website. We use a lot of internal techniques for our quant strategies. A lot of thank you notes and more thank you notes, so if I think that's all we have. If there are no more questions, again, thank you very much for joining this webinar. I hope you found the content helpful, and I will see you on the next edition in 3 weeks, and we'll be posting the slides online very shortly. Thank you very much.